moving right on then, we've got Mr. N Vasudevan. He's the Managing Director and CEO at Equitas Small Finance Bank, here to talk a little bit about their growth outlook and their margins post the quarterly numbers. Thank you so much for joining us. Now, we clearly have seen a lot of companies reprice deposits. Your yields on advances have come off on a year-on-year basis. Will these factors impact your net interest margins?
Good morning. Yes, our interest rates on deposits also have been raised in the last quarter in line with the market. And we expect that, with the yesterday's 25 basis points increase by RBI on the reverse repo, we expect that the interest rates might inch up a little bit more in the coming months. But however, what we do is we try and do a combination of passing on a part of the increase in the interest rate to the borrowers, and a part of it we are able to absorb because our own efficiencies and productivities keep improving over a period of time. So we are able to absorb a part of that increase in the cost of funds, and part of that we pass it on. So we have raised the interest rates in the last quarter, partly to offset this increase in interest rates. And overall, we believe that we should be able to maintain our spreads, reasonably consistently going forward.
Your cost to income has been in the band of about 56 to 66%, Mr. Vasudevan. Should we expect this to continue in that range, or do you think you can up that?
We are largely into the informal sector lending space. And if microfinance contributes about 18%, and the remaining 82% is our secured loans. And if I remove microfinance for a minute, my average ticket size of loans is just 6 lakh rupees. So we are really into that very granular micro lending space. Even if I remove the microfinance from the calculation. So doing a loan of 6 lakhs, you can imagine the kind of cost that will have to be incurred. We employ a fairly large number of people on the field in terms of credit appraisal. It has to be a cash flow based credit appraisal. We don't get too much of documents. And then the collection again is a big, process. So our operating costs will be at this level. So, this is a model where basically you have to incur a fairly high level of cost to do this kind of business. And so our costs will always remain elevated. So something in the range of 60, give or take a couple of basis points up or down, will be our normal steady state cost to income.
My question is that if you're lending to borrowers and if you're enjoying such strong NIMs, and these are the borrowers who are ready to borrow from you because they are not getting loans at a lower rate, what about the default risk?
Yeah, that is normally priced into our lending rates. But if you see the default rates, our pre-corona, our GNPA used to be in the range of 2.5%, and our credit cost per annum used to be around 1 to 1.1%. So it's not that the loans lending to the informal sector is a high risk model. It is not. It is just that the fact that it's so difficult to understand the credit profile and lend to them, that it's actually very difficult. But once you are able to manage that, the performance by the customer itself is not really bad at all. So historically, we have never had a credit cost beyond 1 to 1.1% per annum, which is very reasonable looking at the fact that we are lending to the very, very small borrowers. And now post-corona, our GNPA did go up to 4.6%. And then over the last few quarters, it's come down to now 3.5%, 3.4%, 3.3%. It's been coming down. And we expect that the GNPA to go below the 3% level shortly and back to the pre-corona levels. So we are really not too worried on the credit cost, because these customers, they borrow very small amounts. The livelihood is the business that they are running, and our loans are actually going to help them on their livelihood. And they generally pay up. So long as they are able to open their shop and get the revenue, they are very comfortable repaying it back.
Okay. How do you see a cost of liability moving going forward now that interest rates are nearing a peak?
Yeah, so we did see an increase in the interest cost in the last quarter by about 16 basis points. And we expect that the next 2 quarters we might see again a further increase, because many of the old deposits at low rates will get replaced by new deposits which are coming in at a higher rate. But if you see my CASA percentage, it's around 46%, and we have not really changed our lending interest rates on the savings accounts. So which means that about 45 to 46% of my deposit base, I will not be seeing any change from an interest rate perspective. It's really the balance 55% deposits which should see a change in the cost of funds. But in spite of that, there will be an increase. But as I said earlier, part of that we will pass on, and part of that we will be able to absorb and more or less protect our spreads.
Right, Mr. Vasudevan, great to have you today on ET Now. Thank you so much for joining in and talk about your earnings. Let's just quickly revisit what the market